Look, what has happened over the last few days has been a pretty rapid spread in the coronavirus outside of China. 2,900 cases is pretty much where China was at the end of January. In Italy, going from 3 to something like 300 over the course of a few days really does suggest that what was likely to be a regional shock could be one that's more global.
But here's what I don't understand. We knew this was a risk. Did anybody think this was not going to escape China?
It absolutely was a risk. It was not priced as something that was going to involve a global shock. Now, let's be clear here that all of the things that we do is precautions to keep people safe. That is actually what is holding things back. That if you have
holding economic activity back, absolutely.
And it will have a very big effect. We are not going to have the economy that we thought at the start of the year. We were rebounding from a trade shock, but travel, tourism, supply chains, getting products from factories to consumers, these sorts of things will be interrupted, particularly if we see this move across multiple regions. And that was not what was priced in the markets.
And Jason, Brady, you now have the CDC basically saying to Americans we should explore work from home plans, check in with our schools and daycares, look at telemedicine options. Again, this was part of their weekly briefing, so they're just responding to questions that are naturally coming up. But if that's true, then how much more of a hit are we talking to GDP? And are you supposed to just ride it out in the stock market, or what should investors do?
Look, the challenge with markets today is that valuations are not particularly supportive, and high valuations don't mean that we're going to have any kind of crash. It just means that markets are vulnerable. So what you're seeing is an increase in risks. Certainly the coronavirus is a big increase in risks, potentially as it comes to the United States, and we see some hotspots here. But I'd also point out that the results from the Democratic primary race is another risk and another
Look at the
additional
market,
point
Jason,
of volatility.
Yesterday. The worst performer in the Dow was United Healthcare. I'm pretty sure that wasn't coronavirus. You know, when the major health insurer in the country loses 8% of its market value. So I guess should people then differentiate between stocks that might have a longer political exposure and ones that should recover more quickly if they're coronavirus related?
So look, at Thornberg, we're looking at the long term. What I tell you is that cash flow generative companies trading with an attractive yield, those are interesting. Some of the things that folks believe will be cyclical, maybe less cyclical. JP Morgan, which is coming out with forecasts for 2020 being more challenging. That's been a tough place to be just lately, but banks are going to be less cyclical than they were in 2008. So you got to look at valuations, you got to look at fundamentals. I would just say at the market level, valuations are not particularly supportive.
Right. No, it was just a way of saying the market's expensive and it's pricey, and with all the risks out there, why mess around? Michael Schumacher, let me bring you in to talk a little bit about what's happening in bond markets, because it looks like the 10-year yield could be going below 1.3%. I mean, I have to keep checking it to make sure it hasn't happened already, and that's never happened before. So does that mean going below 1% is next?
Hard to put a floor on it right now, Kelly. I mean, it's interesting, right? You think about the progression of the virus. I don't think anyone can really handicap it. We're all market people. We're not in infectious disease. We don't really know. And yet people are saying, gee, I've got this risk from a business perspective. If yields go lower, it's a real problem. I have to hedge it. It's almost as if people are a little bit indifferent to price or yield at this point. But I want to get back to something Steve commented on a minute ago. And the bond market was actually pricing a fairly grim scenario a while ago. If we had had this conversation a week ago, the 10-year would have been 150-ish, and people would have said, oh, it's really low. It's already down 40-something basis points on the year, and yet equities were up.
Right.
So we think bonds maybe were a little bit ahead. Maybe it's because we people in the bond market are just sort of dour. I don't know. Could be. But in any event, you can't really pin a floor on it right now.
But from where you sit, and this is just, again, inherent to how these things work, but you think the stock market, everyone else is catching up, and the bond market we've proven right here. The only thing I'd say to you is, well, the bond market keeps moving its goalposts. Just a couple of weeks ago, even knowing what we did about coronavirus, we were looking at 1.5%, 1.6%. Sure. What does 1.3 tell you?
We would say the bond market's been a little bit less wrong. That's all. Not the bond market's right. But again, no one can really tell you exactly where it's going. You think about people at the various central banks. Is it a monetary policy issue? Probably not. Does that mean the Fed or the ECB comes in? Who knows? Maybe. But it's really difficult right now to think about the policy response in addition to the rapidly shifting illness or virus. So
I'm going to ask Steve about the Fed in 1 second.